Most companies sell a product or a service. A bank sells money. This inversion of the standard business model dictates every financial rule that follows. Applying the same logic used for a tech company or a retail chain to a bank leads to dangerous financial conclusions. The difference centers on debt. In manufacturing, high debt is a liability to be managed. In banking, debt is the raw material of the business itself. Every customer deposit is an immediate liability. For the bank to generate income and pay its own bills, it must leverage those deposits by lending them out at higher interest rates. Because the business is built on this specific leverage, standard analytical tools no longer work. We have to look past the top-line profit and study the architecture of the risk. Consider two hypothetical lenders. Bank A builds its business slowly, keeping strict reserves. Bank B scales aggressively, doubling its loan book year after year. To a beginner using standard corporate logic, Bank B's explosive growth makes it look like a highly attractive investment. Professional investors look past the height of the tower. They focus instead on the structural integrity required to prevent a sudden collapse. A bank makes its money by capturing a spread. They might pay depositors 4% while charging borrowers 9%. This chart illustrates net interest margin, or NIM. This measures exactly how efficiently a bank earns money from its lending activities. Bank A operates with a 5% NIM. Bank B generates much higher volume, but earns a thin 2.5% margin. Amateur investors often focus on Bank B's larger total revenue, missing how hard the underlying engine has to work just to generate $1 of profit. In this sector, the efficiency of the lending spread matters more than total loan volume. Massive size often masks declining profitability. Rapid loan growth is often mistaken for a sign of a high-quality investment. To maintain that pace, aggressive lenders like Bank B often lower their standards, extending credit to increasingly risky borrowers. We track the damage through non-performing assets, or NPAs. This represents the specific percentage of loans where borrowers stopped making their payments. Bank A's careful screening kept its failure rate to 1%. Bank B's aggressive expansion resulted in a dangerous 8% NPA ratio. Banks earn profits slowly over years, but they take losses instantly when a loan goes bad. A single cycle of reckless lending can erase a decade of accumulated earnings. Because the balance sheet is central to survival, investors price banks using the price-to-book ratio instead of traditional earnings multiples. Bank B often trades at a severe discount to its book value compared to Bank A, which can look like a bargain. Professional analysts view a deep discount as an alarm bell. It signals the market believes the underlying loans on that balance sheet are already toxic. A deep discount in this sector usually reflects a lack of market confidence. Investors are often pricing in the high probability that those underlying loans are already failing. The true test comes when the economic environment shifts. Rising interest rates act as a stress test for the entire financial system. As borrowing costs rise, weak businesses default. The critical flow of loan repayments to aggressive lenders like Bank B begins to stop. This creates a sudden need for liquidity, the cash buffer required to meet the demands of panicked depositors. Bank A uses its reserves of cash and government bonds to meet withdrawals. Bank B is trapped, holding non-performing loans that cannot be easily converted to cash. Historical banking crises rarely stem from a slow decline in profits. They are almost always triggered by a sudden evaporation of liquid cash. Banks operate on trust. When that trust vanishes, the institution does not fail slowly. It can collapse in a matter of days. The metrics that make a bank look successful during periods of easy money become dangerous the moment the credit cycle turns. Successful banking investment requires identifying the specific risk management and liquidity buffers needed to survive